1 month ago, SpaceX pulled off the largest IPO in stock market history. A $1.77 trillion valuation, 19% pop on day one. Elon Musk became the world's first trillionaire before lunch. And today, the stock is trading below its first-day close, sitting near its IPO price, and the technical signals are flashing strong sell. So which is it? A $2 trillion rocket or a falling knife? I ran SpaceX through AlphaLens, an AI-powered research platform that applies 15 institutional-grade analysis frameworks, the same kind hedge funds use. Here's what it found. Stick around, because the numbers on this one surprised me. First, the setup. SpaceX priced its IPO at $135 a share on June 11th and started trading June 12th under the ticker SPCX. It closed day one at $160.95, a 19% gain and a $2.1 trillion market cap. That made it the sixth most valuable company in America instantly, but since then, the air has come out. As of this week, shares trade around $145. That's below the day one close, barely above the IPO price, and the market cap has slipped under $2 trillion. Retail investors who chased the pop are underwater. So the question every investor is asking, is this the dip you buy or the top you sell? Let's start with the bull case, straight from the AlphaLens bull versus bear framework. This is not just a rocket company anymore. SpaceX today is 3 businesses in one. Business 1, launch. Falcon 9, boosters fly 15 to 20 missions each, and SpaceX launches more rockets per year than every other provider on Earth combined. That's a near monopoly with a structural cost advantage nobody has matched. Business 2, Starlink. A real scaling subscription business, satellite internet with millions of subscribers, expanding into aviation, maritime, and direct-to-phone service. Recurring revenue, growing fast. And Business 3 is the one most people missed. AI. The public company includes Grok, the X platform, and massive AI computing infrastructure, including a deal where Google pays roughly $920 million a month for compute capacity. Rockets, internet, and artificial intelligence under one ticker. That's the bull story, and it's why 26 of 27 Wall Street analysts rate this stock a buy, with an average price target around $242, more than 60% above today's price. Now the bear case, and buckle up. AlphaLens ran a fair value stress test, and the valuation math is brutal. This company loses money. Earnings per share over the trailing 12 months, negative $2.94. The most recent quarter showed a net loss of over $4 billion. There is no PE ratio because there is no E. You are buying a story about future cash flows, and the skeptics are loud. Morningstar puts fair value near $780 billion, less than half of where the stock trades today. Legendary investor Jeremy Grantham called the valuation risky, built on bold AI bets and speculative orbital infrastructure. One analyst slapped a sell rating on it with a $115 target the day it went public. When smart money disagrees this violently, a $242 average target versus a fair value estimate of half the market cap, somebody is going to be very wrong. The AlphaLens risk assessment matrix flagged 5 risks, and 3 of them deserve your attention. Risk 1, key person risk. This entire thesis runs through Elon Musk, who also runs Tesla and carries more headline risk than any CEO in America. One controversy, one distraction, and this stock moves. Risk 2, Starship. The long-term growth story depends on Starship becoming a commercial workhorse. it isn't one yet. Delays or failures directly impair the trillion-dollar dreams baked into this price. Risk 3. Volatility itself. This stock has a beta over 7. That means when the market sneezes, SPCX catches pneumonia. If you can't stomach 20% swings, this is not your stock. So what's the catalyst? Circle August 6th on your calendar. That's SpaceX's first earnings report as a public company, and it's a make-or-break moment. For the first time ever, investors get real segment disclosure, actual Starlink revenue, actual launch margins, actual AI numbers, not leaked estimates. If those numbers back up the story, the stock has room to run toward those analyst targets. If they disappoint, there's a lot of air underneath this price. And one more thing the pros are watching: the IPO lockup. When insider selling restrictions expire, early holders can dump shares. That's a supply wave that has crushed plenty of hot IPOs before. So here's the AlphaLens verdict: high risk, high optionality. This is a genuinely transformative company, a launch monopoly, a scaling internet business, and an AI platform, trading at a price that already assumes a lot goes right. The bulls need Starlink to keep compounding, Starship to work, and Musk to stay focused. The bears just need one of those to slip. Nobody can tell you whether to buy. That's your decision, based on your own risk tolerance. But now, you know exactly what the smart money is arguing about and exactly what to watch on August 6th. Here's the thing. This entire analysis, the bull case, the bear case, the fair value stress test, the risk matrix, took AlphaLens about 60 seconds to generate. A Bloomberg terminal costs $24,000 a year. AlphaLens runs the same institutional-grade frameworks on any US stock for $39 a month, or a one-time $99 founding member lifetime deal, which jumps to $149 a year after the first 100 members. The link is in the description. Run your own portfolio through it before earnings season hits. If this breakdown helped you, hit subscribe and like. New AI-powered stock deep dives every Friday. This is AlphaLens Investing. Trade smart.